The fragile part of finance is not always the bank with a branch on the corner. It can be the fund, the repo trade, the cash-like product, or the pension strategy promising liquidity while depending on markets that may freeze. The central question is simple and uncomfortable. If the next crisis starts outside the banking system, will the public even recognize the bank-like machine that is breaking? This is No Finance. This episode is not about calling every non-bank institution dangerous. Market-based finance can move savings into credit, help companies fund themselves, and give investors tools for cash management and risk transfer. The problem begins when liquidity promises, leverage, or dependence on market liquidity collide under stress. According to the Financial Stability Board's 2025 Global Monitoring Report, using 2024 data, non-bank financial intermediation is now roughly half of global financial assets. That is the broad measure. The FSB also tracks a narrower category focused on activities that may pose bank-like financial stability risks. It is smaller than the total, but the larger point remains. Market fragility cannot be explained by banks alone. Traditional banks transform short-term deposits into longer-term loans under a heavy supervisory framework. Some non-bank entities and strategies perform bank-like functions outside that perimeter. Liquidity transformation, maturity transformation, credit intermediation, and leverage, often through funds, finance companies, securities markets, and certain insurer or pension-related strategies. Many non-banks do not pose the same risks. The focus here is on structures that transmit stress. The question is not whether these institutions are useful. Many are. The question is whether promises made in calm markets can survive when prices gap, collateral demands rise, and everyone tries to turn similar assets into cash. The misconception is that financial system risk lives mainly in banks because banks are where the public can see it. A queue outside a branch is visible. A repo lender pulling funding from a hedge fund is not. Take money market funds. They are useful cash management vehicles for households, companies, and institutions. They invest in short-term instruments like Treasury bills, repurchase agreements, commercial paper, and other high-quality money market assets. But the trade-off is in the structure. Investors often treat shares as cash-like. The fund's assets still depend on functioning short-term markets. The vulnerability is typically greater in prime and tax-exempt money funds than in government or treasury funds, because the assets and stress dynamics differ. But no cash management vehicle is free of liquidity risk. Historical runs and repeated reforms show that this is not theoretical. Money funds have been reformed more than once because cash-like promises can become fragile when investors question who exits first and who is left holding assets sold under pressure. In July 2023, the SEC adopted additional money market fund reforms aimed at improving revenues, including higher daily and weekly liquid asset requirements and a liquidity fee framework for certain institutional prime and tax-exempt funds. The final rule did not adopt swing pricing. Instead, it used liquidity fees to make redeeming investors bear more of the costs they can impose in stress. The policy message was clear. Useful cash vehicles can still create systemic questions when redemption incentives line up. So the first answer is this. The logo on the door tells you less than the funding chain behind it. And that leads to the next question. What makes these chains fragile? The core mechanism is liquidity transformation outside the banking perimeter. Investors expect quick access to cash. The underlying assets or strategies may depend on market liquidity that disappears under stress. That mismatch matters because finance often treats liquidity as normal. But liquidity is not a permanent feature of an asset. It is a market relationship, a buyer, a seller, a price, balance sheet capacity, and confidence, all available at the same moment. Now add leverage. In hedge funds and other non-banks, leverage can be direct borrowing through repo and margin loans, or synthetic leverage through derivatives. Both can amplify market moves because a small price change can force a large adjustment in collateral or exposure. If prices fall, lenders and counterparties ask for more margin. To meet the call, the leveraged investor may sell assets. Those sales can push prices lower, triggering more margin calls. The mechanism is mechanical, not moral. This is where measurement gets difficult. Regulators can see more than they used to, but private funds, offshore structures, family offices, repo financing, and derivatives leverage can still leave gaps. Synthetic leverage is especially hard to summarize because the risk may sit in contracts rather than obvious borrowing lines. That is why the FSB's 2025 work on leverage in non-bank financial intermediation emphasizes not only leverage itself, but also data quality, concentration, counterparty links, and stress transmission. The danger is not one fund being wrong, it is many institutions discovering at once that their liquidity assumptions depended on the same market depth. Back to the screen we opened with, the weak point is not necessarily a bank run in the old sense. It can be a collateral run, a redemption wave, or a margin spiral. Now move to March 2020, into the market many investors treat as the center of global safety, US Treasuries. The wait what moment is that even this market showed severe dysfunction. The FSB's holistic review of the March market turmoil described a broad dash for cash. Non-bank selling pressure, redemptions from open-end funds, margin calls, and pressure in short-term funding markets interacted across the system. The official finding is not that one trade alone broke the Treasury market. The evidence points to multiple channels reinforcing each other. There is also a debated interpretation around the Treasury basis trade, where leveraged investors exploit small price differences between cash treasuries and Treasury futures. Some analysts argue that unwinding of leveraged basis trades contributed to Treasury market stress in March 2020. Official reports treat that channel as important to monitor, while emphasizing data limitations and the broader dash for cash environment. That dimensional matters. If the diagnosis is too narrow, the policy response may miss the next pressure point. Open-end funds added another mechanism. Investors can often redeem fund shares quickly, but the fund may hold assets that are harder to sell under stress. Managers may sell the most liquid assets first, protecting immediate redemptions, but leaving remaining investors with a portfolio that is harder to liquidate. The size of that first-mover advantage depends on the fund's rules, asset mix, cash buffers, and liquidity management tools. This is not a claim that open-end funds are bad. They democratize access to diversified portfolios and help capital markets function. The fragility appears when daily liquidity is offered on assets whose market liquidity is conditional. Now shift to the United Kingdom in 2022. Liability-driven investment strategies used by pension funds to match long-term liabilities faced a shock when gilt yields moved rapidly. The operational reveal was that pension sector leverage could become a financial stability problem. As yields rose, collateral calls increased. To raise cash, some funds sold gilts. Those sales could push gilt prices down further and yields up further, producing more collateral pressure. The Bank of England stepped in with temporary gilt purchases to restore market functioning. The pension strategy had a real institutional purpose, helping funds manage interest rate risk against long-term obligations. But in stress, the liquidity need moved faster than the ability to raise cash without destabilizing the market. Remember the measurement problem. In episodes like these, the hard part is not just knowing who owns the asset. It is knowing who must sell if prices move, who owes collateral tomorrow morning, and which counterparties are exposed if liquidity disappears. By the Federal Reserve's May 2026 Financial Stability Report, with market conditions assessed as of April 23, 2026, non-bank leverage, funding vulnerabilities, and market liquidity remain part of the stability framework. The IMF's April 2026 Global Financial Stability Report also keeps attention on leverage, liquidity, and the interaction between market stress and financial intermediaries. The investigation has changed the object. We are no longer looking for a single villain. We are tracing a system of promises, funding, collateral, and forced behavior. The revelation is that shadow banking is less a secret room than a set of balance sheets that do not look like bank balance sheets. The risk may sit in a fund share, a repo haircut, a derivative margin schedule, or a pension liquidity plan. The same channels that make markets efficient in calm periods can amplify stress when leverage, redemptions, and margin calls force similar actions. A good market structure in normal times can become fragile when participants depend on exit liquidity that is not there. This is why shadow banking can be misleading if it sounds like fraud by default. Much of it is legal, visible to some regulators, and economically useful. The real issue is that bank-like risk can migrate to places where oversight, data, and liquidity backstops are incomplete. The policy debate is not simply regulation versus deregulation. It is about transparency, liquidity buffers, margin preparedness, leverage limits, central bank backstops, and who bears the cost when emergency support is needed. If central banks intervene to stabilize markets, that can prevent broader damage. But repeated interventions can shape expectations about rescue. The trade-off is not clean. Too little support can allow fire sales to spread. Too much predictable support can encourage fragile structures to grow. Back to the object we started with. A bank branch is easy to recognize. A bank-like machine made from funds, repo, derivatives, money market instruments, and pension strategies is harder to see. For investors and citizens, this is not a prompt for portfolio advice, fund recommendations, or timing calls. It is a way to read the financial system. Ask what promises liquidity, what holds less liquid exposure, what uses leverage, and what must sell when prices move. The most important risk is often not the name of the institution. It is the sequence of obligations. Cash goes in, securities are financed, derivatives create exposure, margin moves, redemptions arrive. The balance sheet shrinks under pressure. And when many institutions follow that same sequence, private liquidity problems can become public financial stability events. Shadow banking is not a hidden villain so much as a hidden balance sheet, useful in normal times, dangerous when leverage, liquidity promises, and incomplete oversight line up in the same direction. If the next crisis starts outside the banking system, will the public even recognize the bank-like machine that is breaking? This episode follows the money through the institutions that look safe in calm markets and become systemically important when liquidity vanishes. Watch the funding chain, not just the logo on the door. The next bank run may not happen at a bank. This is financial system analysis, not investment advice.